Hello, I'm Lee, and this is a video series called Advanced Topics in Credit Spreads. These are calls and puts that are put together in combinations that we call vertical spreads, and we do them for credit. So this is more of an advanced video. So if you don't know anything about credit spreads, this probably isn't for you. There's a ton of videos on the internet for the beginner or basic credit spreads, but this kind of does a deep dive and goes into a lot of the details that are kind of left out on some of those other beginner videos. So let's get started. Let's take a look at these advanced topics in credit spreads. This is the first of maybe 3 or 4 videos. Here goes. We're going to do a little bit of a review and see what a call option is. A call option is the right, but not the obligation, to buy an underlying stock for a specific strike price until a specific expiration date. So an example might be that you buy a call option and you have the right to buy a stock for $100 from now until November 15th, something like that. So when you buy a call option and you have the right to buy that stock, somebody else had to sell that call option, and you are able to force them to sell that stock to you. And that's a contract. It's a contract that obligates them but gives you the right to buy the stock at a specific price on a specific date. So if we look at a call option, what we know is that it has some value, and that value is primarily based on the stock price. So if the stock price goes up, the value of that call option goes up as well. But if the stock price goes down, the value of the call option goes down. Okay, so we have another thing. It's called a put option, which is the exact opposite. It's the right, but not the obligation, to sell an underlying stock for a specific strike price until a specific expiration date. What that means is if you buy a put option, you have the right to force somebody to buy a stock from you at a specific price. So say you buy the right to force somebody to buy the stock for $100. They have the obligation to buy it from you, but you don't have the obligation to sell it to them. So what happens with a put option is it's based primarily on the stock price as well. As the stock price goes down, the value of the put option goes up, and the stock price goes up, the value of the put option goes down. It's inverse. So the put option is the right to force somebody to buy a stock at a specific price. Okay. Moving on. That's basic review, that's basic options, but the thing that you have to realize about options is they have a thing called theta decay. And what that means is that the value of an option goes down with time, reaching 0 at expiration. Well, out of the money options are made up entirely of what's called extrinsic value, and the extrinsic value goes to 0 at expiration. And it's really important that you realize here that if you are a seller of an option, you are collecting theta decay, and if you are the buyer of an option, you are paying theta decay. So every single day as time passes, the value, or at least the extrinsic value, gets lower and lower and lower. And if you bought an option, well, that cuts into the value of your option. But if you sold an option, well, that reduces the value of the option that you sold. So if you're short on an option, if you sold an option, that's good. You want to collect theta decay. So anyway, if we look at a graph, what we can see is that the value of an option is based on the spot price, or the value of the stock, and the time to expiration. And what we can see is that there's variations in the options value based on time and price. But there's another thing that plays a role in it, and that's called implied volatility. Now, it's important to realize that implied volatility is slightly different than volatility. Volatility can let you look at a stock and see what the expected range of trading is. So say a stock is trading for $100 and there's a certain amount of volatility, you can say, well, it might go up $5 or it might go down $5. Or if it has really high volatility, maybe it'll go up $20 or down $20. We don't know if it's going up or down based on volatility. We just know what the normal range is. Well, implied volatility is the marketplace's interpretation of what volatility is. Not the mathematical volatility that can be calculated, but instead it's what everybody on average seems to think the volatility is or should be. And what it does is it implies the amount of movement. So the volatility may predict a movement of $5 up or down, but the implied volatility may predict a movement of $10 up or down. In any case, volatility makes up a large part of the options value, because if a stock is very volatile, then the value of the option is a lot higher because it could shoot way up. In any case, if implied volatility increases, it increases the value of an option. And if implied volatility goes down, it decreases the value of the option. So these are the major components. It's expiration or time till expiration, the price of the underlying, and volatility can take that entire thing and raise it up or down. Okay, so just to review, when you have a long call option, that means that you bought a call option and that you're looking for a strong, fast move up. You're not just looking for a move up. I mean, you can predict the direction of the stock, but that doesn't matter. What matters is that it moves up stronger and faster than the marketplace expected. Because keep in mind, implied volatility is already built into the price of the option. So moving up isn't good enough. It has to move up fast enough to outpace theta decay, and it has to move up more than the market predicted with the implied volatility. So you're not just looking for a move up to make money on a long call option. You're looking for a strong, fast move up that outpaces theta decay and it outpaces the implied volatility. Again, if you go long, you bought a call option. But if you're short, you sold a call option, right? So that means that you're looking for anything but a strong, fast move up. When you're long, a strong, fast move up wins. But when you're short, anything but a strong, fast move up wins. It can move up a little bit, nice and slow. It could move down. It could stay where it is. And when you're short on a call option, you make money either way, no matter how it goes, as long as it's not a strong, fast move up. And again, there's a long put option. And there you're looking for a strong, fast move down. You're looking to outpace theta decay, and you're looking to outpace the implied volatility. And if you're short on a put option, that means that you sold a put option. You're looking for anything but a strong, fast move down. Okay, got it? Let's take a look at some of the graphs. Okay, long call, very bullish. You're trying to outpace theta decay and volatility. On the day that you buy it, you actually buy it for a debit. That means that you pay a premium to buy the call option. Now, if the stock price goes down, you can never lose more than you invested in the option premium. But if the stock price goes up, you have unlimited profit potential. Now, the problem with that is that, again, you have to outpace theta decay. It can't just go up. It has to go up fast enough and strong enough for you to actually make money. Okay? So then, that's a long call option. And when you buy a call option, that means that somebody else had to sell that call option. So let's take a look at the opposite side of this. That would be a short call option, where a long call option is very bullish. A short call option is not very bullish, or even neutral or bearish. So when you sell a call option, what happens is you collect a credit at the time that you sell it. You collect a premium to sell that call option. And that's money in the bank. You get to collect that premium and put it in your pocket. You can take it to Starbucks or do whatever you want with it. Now, if the stock price goes down, you're safe. You get to collect that premium and keep it, and you have it forever. But if the stock price goes up, then you can have unlimited downside potential. That means that you have unlimited risk. If the stock goes up $1 million, you get to come out of pocket $1 million. So it's not a very safe position. We call this going naked or selling a naked call option. And there's a lot of risk involved in doing it. If you did it way out of the money and the price stays under your strike price, maybe you're okay. But most people like to hedge this with owning the stock, and that would be writing covered calls Or the other way that you can hedge this is to do a thing that's called a bear call spread. Now this is a bearish position or neutral, or at least not very bullish. In any case, you have defined risk. Instead of unlimited downside potential, you've defined your risk. So what happens is you sell a call for a credit, and if the stock price goes down, then you get to keep the money. But if the stock price goes up, you lose money up until your defined risk point, and you cover your risk by buying a call option for a debit. So if the stock continues to go up past that point, you actually can't lose any more money than that. And this is called a spread. What's happening here is that if the stock price moves down, you make a defined profit, and if the stock price moves up, you have a defined loss, and that's why we call it a spread. All right, let's take a look at a long put option. In this case, you're very bearish. You're thinking the stock is going to move down strongly. On the day that you buy the long put option, you buy it for a debit, and that means that you pay a premium to buy the put option on the day that you acquire it. And if the stock price goes up, you are out the amount that you paid for the option. But if the stock price goes down, and if it goes down fast enough, you go into the money and you have great upside potential. Whatever the value of the underlying stock is, that's your potential for a long put option. Again, the problem with a long option is that you have theta decay. The extrinsic value approaches zero as you reach expiration date. So what that means is for every day you hold that long put option, you're losing money. So with a long put option, you have theta working against you, but on a short put option, you have theta decay working for you. So on the day that you sell a put option for a credit, you collect a premium to sell that put option. And if the stock price goes up, you get to keep that credit. But if the stock price goes down, you have almost unlimited downside potential. So we can get around that by using what's called a bull put spread. So in this case, you're a little bit bullish on the stock, or you're neutral, or at least you're not very bearish. It might go down, but it won't go down too much. So here's what happens. You have a defined risk play. So you sell a put for a credit, and if the stock goes up, you get to keep that credit. And if the stock goes down, you lose money. But you lock in your risk by buying a put for a debit. And if the stock continues down, you can never lose more than your defined risk. So again, in this case, you have a maximum profit potential and you have a defined risk. And this way you can calculate your risk-reward ratio. Okay, so what does all this mean? How do you make money with credit spreads? Well, you start off by selling a spread for a net credit, and then if the price doesn't move against you too much, meaning it could move in your favor, or it could stay where it is, or it can even move against you a little bit, but as long as it doesn't move against you too much, you still make money. The implied volatility can decrease, and time will pass, and eventually it could expire out of the money entirely, and you get to keep the entire credit. How do you lose money on a credit spread? Well, if the price moves against you too much, you lose. If the implied volatility increases, it changes the value and it can work against you. And if it expires in the money, it could end up costing you money. Okay, so there is another variation of this. If you were to take the bull put spread and the bear call spread and put them together, you end up with what's called an iron condor, which is a very neutral position. You're saying that you expect the price to stay within this range. You have your break-even point on the left and you have your break-even point on the right. And if you think that maybe there is support and resistance at in this range, that maybe the stock price is going to be ranging for a while in here. If maybe you think it's going to range in this vicinity for 30 days, and you can sell an iron condor, collect the credit, everything expires out of the money, and you've made money. Okay, but the thing that you have to remember is that theta decay is an important factor. If you are short on an option, or if you've sold a spread, then theta decay is working in your favor every day. And if you're long on a spread or you're long on an option, Theta Decay is working against you every day. And also you have IV mean reversion. So if you sell a spread or an iron condor while IV is high, then IV can go down, decreasing the value of your spread so you can buy it back for a lower price. Okay, that's the end of the first video. In the next video, we're going to get a lot deeper into credit spreads. We're going to start looking at things like probability of profit. We're going to look at some of the Greeks and see how delta plays a role in predicting your probability of profit, and look at risk-reward ratio and all kinds of things like that. I'll see you in the next video. If you want to see more videos in this series, make sure you click the like and subscribe buttons below.